Guys, Tesla just reported yesterday after hours, and they missed big. As of after hours, 30 minutes later, they were up about 7%. They reported 45 cents earnings per share versus 51 cents expected. That's a drop of 48% versus the quarter 1 year ago. Revenue came in at $21.3 billion versus an estimated $22.3 billion. Now, guys, we talk about Tesla a lot, and the reason being is Tesla is a company that was so hyped at $414 per share just 2.5 years ago, has fallen from grace to $150 per share. $150 per share. It is absolutely insane. Now the question becomes, why is this? Revenue's gone up, profit's gone up. This quarter was really bad, but overall you sit there and say, why? Well, guys, because of hype. It is possible to overpay for a good thing. I have videos in which people criticizing me, and I said, I bet you there'll be a time when we don't see, 10 years from now, we still haven't seen the same price on Tesla. I don't know if that's going to happen or not, but it wouldn't shock me because markets are irrational. In which you send a company like NVIDIA up 10x in a matter of a year and a half, that is not a rational market. You don't send a $2 billion company up 10x in a year and a half from rationality. When you look at Tesla, Tesla's had all these distractions, but keep in mind, great news, great news, great news, bad news, bad news, bad news. But this bad news is only because the stock went down. News follows the stock price. I cannot stress this enough. I started to think that good investing was 90% fundamentals, 10% emotion. It's exactly flipped. Great investing is 90% emotion, 10% fundamentals. That's why we have these tools here. I want you to be able to look at the fundamentals of the business. That's why I make these videos. Let's focus on the fundamentals. Remember, guys, if you're an investor and you don't own Tesla here, you're pretty excited at this. You're like, oh my God, the stock is down so much, 60, 70% down. But the same person, if they bought here, would not be as excited anymore. Why? Because they have this sunk cost. Like, oh my God, I just paid $400 for this company. I hate this. But you got to evaluate the companies based on where they stand at that given time. And right now, the news on Tesla is not great. They just recalled every Cybertruck that's out there. Granted, it's not many. They just laid off a ton of employees. They just cut prices again and cut production on some cars. So let's go check out their press release to see some of the things that they're announcing. First off, total automotive revenues down 13%. And guys, this tech company everybody speaks of, 17.4 of their 21.3 billion in revenue is from cars. This number here includes their full self-driving software. But I haven't seen where they split that out yet. So 80% of their revenue comes from cars. How is it a software business? I see this all the time on our 24/7 channel. Yesterday after hours, I sat there and said, guys, if you go to high school and you see a star player who everybody thinks for sure is going to go pro, you don't call him a pro athlete yet. You wait for him to become a pro athlete because these things happen. Markets shift. Momentum shifts. People's love shifts. That's so important to understand. Energy and services up 7%. Energy and storage. Services and other revenue up 25%. Okay, not bad. Overall revenue down 9%. Here's the things that scares me. Gross profit 17.4, down 2% from 19.3. That bothers me, guys. Their gross margin keeps becoming more and more like a car company. A car company. Because software businesses would blow their brains out if they had 17.4% gross margins. A bad software business is 50+% gross margin. This is not, looks like a duck, walks like a duck, talks like a duck. Guess what it is? It's Tesla. And keep in mind, I love Tesla. I have a Cybertruck in order. I had a Model X. Mo has a Tesla. We love Tesla. But I'm separating the car company from the stock. That's so important. If you attach those two things together, you're going to make a lot of bad decisions. You've got to be completely agnostic as to what the company is. Not completely. You got to factor in the growth, but don't fall in love with the company. Don't fall in love with the company because you'll just look for any reason to buy it. And that's what was happening right here. That's what's happening right here. I love it. I love it because I see the stock price go up. And guys, guess what? I was wrong all along this way because a company is still fundamentally, and we'll get into that in our stock analyzer tool, is worth more than when I was saying it was overpriced back here. So I get that. But you still have to remember that if you bought it here, good for you. But I hate to say it, you probably didn't buy it based on fundamentals, and that's okay. But you can always change that methodology, and that's what I'm here for. I'm here to teach you these fundamentals. But more importantly, I'm here to teach you the emotional side of investing. That way, if you love the company now at 150 and you sit there and think it's a buy, friend of the channel, Professor Aswath says that he likes it sub 180, right, Dalton? He's buying it. So he likes it sub 180. If it goes to 90, and by the way, for those of you who think it's not going to go to 90, guys, it was 101 just like a year and a half ago. But anyhow, at 90, he should love it and buy more of it, unless his thesis has changed. And the thesis shouldn't be changed based on emotional garbage coming out in the media. The way the thesis changes, the fundamentals have substantially changed. The future 10 years down the road has substantially changed. That's the reason you change your thesis. But that emotional ride to be able to watch it go from 150 down to 90, that's a tough go. And you're not alone if you think it's tough. We've all been there. We've all bought companies and see them go down. Guys, Joel Greenblatt says, it is nearly impossible, and he's right, to buy a company at the bottom. When you buy a company, invariably at some point you will be down. But keep in mind, I give this example all the time. I bought Carnival Cruise Line and I made money on it. And guess what? I was wrong about Carnival Cruise Line. Literally wrong. They took on way more debt than I expected and they issued way more shares than I expected them to do that. Totally butchered my thesis. And guess what? I still made money. Why? Because the emotional whims of the market drove the stock price up. By the time I realized my thesis had changed, the stock was up. Great. I got lucky. Just like I bought stocks where they go down. Did I think I was wrong because of that? Absolutely not. If you understand the fundamentals, you're going to be able to handle your emotions, and you're going to be around a community of people here in our community to be able to sit there and say, guys, what am I missing? I still think this company is good. And you have that conversation. And that's all I'm asking you to do, is to understand that investing is 90% emotion. It absolutely is all about handling your emotions to be able to compound and keep on to companies that might be down like this if you truly believe they're good values. If you believe Tesla was at 414, please tell me you've been unloading on it. You have to. Because buying it at 414, the revenue is higher. Yes, they might have gross profit issues and things like that, but that's temporary. They can get through that. The question is the business fundamentally sound? So if you want to understand more about the emotions and be able to handle your emotions better, click the link below, $7 for 7 days, join the community. You get the tools to make the right fundamental decision, and you have the community to help guide you and feel more confident and be able to handle your emotions to ride great companies up to higher prices over the years. $7 for 7 days. Make sure you sign up because we have a wait list starting soon, so beat the wait list now. A $500 billion market cap business. Price to sales ratio 5.2. Why do I point this out? Well, a typical car company average for price to sales is 0.5 to 1. This is at 5.2. That is 5 to 10 times higher. Again, people are going to say software. Guys, somebody tell me the breakdown of the software revenue in their car revenue. I want to know that. But the fact they don't break that out as easily, even somewhere buried, is like, well, guys, if it's such a big driver of value, separate it. Usually companies separate numbers after they've had the company for a while, like Facebook and things like that, and things have slowed down. That's when they stop reporting. So if things slow down, well, guess what? They've also dropped the price on their FSD quite considerably. Quite considerably. I don't know, it makes me wonder about the company. Guys, free cash flow, $4.36 billion last year. But let's go check out their current release, their press release. This is what's scary here. Net cash by operating activities, down 90% year over year. 2.5 billion to 240 million. Last quarter it was 4.4. Free cash flow went from 440 million the same quarter last year to negative $2.5 billion. But their cash and cash equivalents investments went up 22.4 to 26.83 billion. 20% increase. Okay, not bad. From a revenue standpoint, revenue down 9% to 21.3, we talked about. Reduced vehicle average selling price year over year. They reduced the prices on cars. They want to spur demand. That's what they did. Decline in vehicle deliveries, partially due to the Model 3 update in the Fremont factory and the Giga Berlin production disruptions. These things happen to companies. That's why you need that margin of safety. That's why you can't assume that you need the rosiest assumptions to make your money. And at $414 per share, you need the rosiest assumptions. But in your defense, if you paid $414 for it, you saw them hit those rosy assumptions for 10 years. So of course you're like, listen, they'll still keep doing it. Guys, Taking a company from 1 million units a year to 10 million units a year, that's not easy. That's very difficult. Do I think Tesla can do it? If anybody can, it's Elon. But he's got a lot of distractions out there. He's trying to go to space. He has Starlink. He has the Boring Company. He has building tunnels. All these things are going on. Twitter, X. These are the things to remember. And those things were existing, except for Twitter, 2.5 years ago. So you can't now sit there and say, wait a second, he's distracted. He was distracted 2.5 years ago, guys. He has 11 kids. He's too busy paying child support. Of course he's distracted. Reduced vehicle ASP. Increase in operating expenses partly driven by AI. The first person to blame AI for operating expenses being higher. The production ramp for Cybertruck was increased. Decline in vehicle deliveries, partially due to Model 3 update, like we talked about it before. Now, they did have a benefit. Lower cost per vehicle, including lower material costs, freights, and duties. That's good. Gross profit growth in energy generation and storage. Higher FSD revenue recognition year over year due to release of auto park feature. Oh, that's good. Let's see what those numbers are. Higher FSD revenue generated. Great. How much higher? We need to know these things. If you think Tesla's a software business, the first thing you need to do is know exactly how much they sell in software, what's that gross margin, and how is it growing. Let's see that. If you don't know that number and you think Tesla's a software company, you need to burn your money. You don't know what you're doing. Go buy ETFs and just stick with them. You can't make your entire thesis on a company something and then not know about it. I believe Southwest and Disney will get back to normal margins. And I understand how that happens, okay? Don't tell me that you don't know the exact revenue. I'm just going to start saying that to everybody on Twitter who says it's a software business. Great. Tell me their software sales. Tell me the gross in their software sales. What is the gross margin in their software sales? That's what's important here. Now, some of the other exciting news for Tesla. Tesla locations, mobile service fleet, supercharger stations, supercharger connectors. All these things up big. 26, 12, 26, and 27%. Storage deployed, up 4%. Okay, a couple pieces of bad news. Total production down 2%. Total deliveries down 9%. 422,000 down to 368, even though production is only down 2%. Makes you ask questions. And these are the questions that to ask. And these are the things that take into consideration when you're buying a company. When you buy them at absurd valuations, like Meet Kevin, you have to understand what is going to drive this value. At the end of the day, profit and revenue are going to drive the value. That's what's going to drive the value. As long as they're not diluting shareholders. Let's see what they're doing. Well, guys, they've increased their share count in the last 5 years by 18%. That's why it's one of my 8 pillars. Because dilution kills investors. Free cash flow is up. Net income is up even higher. But look at this 5-year PE and 5-year price of free cash flow. 76 on the PE, 132 on the free cash flow. This doesn't even include this quarter that's it's updated. This will update in a couple of days. So it's going to be even worse than this. Did a decent ROIC. Guys, you're looking at Tesla, the car company here. I hate to break it to you, looking at Tesla, the car company. Bring the hate on. I love it. I absolutely love it. This is a car company. And I hope someday they do become a software business because I'm quite sure there'll be a time in the future I'm going, I love this stock. At some point there will be. As of right now, I'm sitting there going, let's go check it out. Let's see what analyst estimates are. 378 per share this year is the estimate, going to 809 by December of 2028. That's over double. That's great. What about revenue? From 114 billion this year to 260. Now the issue is they missed by $1 billion. So maybe this comes in at 110. I don't know what's going to happen, but still some great growth here. Let's check out the stock analyzer tool and see exactly what we think it's worth. Let me pull it the last time I did it. May 22nd. Oh, wait, that was yesterday. So revenue growth assumptions. I did 7 on the low side, 12% in the hot middle, 17 on the high. That's for 10 years. Guys, these are big numbers. 17% revenue growth for 10 years is a lot of revenue growth. Just to show you what that is, let me show you. 17% is 1.17 to the power of 10, which is 4.8x. They did like roughly $100 billion in the last year, so they're expected to do $480 billion in 10 years. Completely plausible. The question is it probable? If they want to become the number 1 car manufacturer in 10 years, that would happen at a much lower price per car. And that's a criticism we got 3 years ago. I said, guys, they can't sell 15 million cars at $100,000 a car. it's got to be 15 million cars at a $30,000 or $40,000 price. And that's going to hurt margins in all likelihood. But nobody wants to hear it when you love a company so much. So back to the stock analyzer tool. For profit margin, I did higher than most car companies. I did 6, 9, and 12%. Maybe that's not enough to factor in the full self-driving margins. But again, what are those margins? We don't know. So could you go higher? Listen, I'll go higher on this one. I'm going to go 7, 11, and 15. Let's give it the benefit of the doubt. Now, PE and price of free cash flow. I did 15, 20, and 25. That seems reasonable because remember, in 10 years, if they're the number one car manufacturer in the world, are you giving them a 20 PE? Guys, we've already seen that other manufacturers came in electric. What's the novelty then? I don't know. And again, 9% return, the market return. What this means is there's no margin of safety in here. For margin of safety, you got to put a higher return here than that. And remember, we need margin of safety for 3 reasons. Valuation is an imprecise art. The future is unknown, and we're humans. We're going to make mistakes. And before I hit the analyze button, I want to remind you guys, the emotional part of investing is the hardest part. So click that link, join for $7 for 7 days. It'll change the way in which you view money. And I'm guessing it'll probably make you a better investor. Hit the analyze button, and I'll leave you with this. A low price of 40, high price of 265, middle price of 111, assuming no margin of safety. I am OUT on Tesla. Thank you for your time.